Good morning, folks. I'm calling to order our meeting of the Marin Municipal Water District's Finance and Administration Committee. For August 24th, could we get a roll call?
Yes, good morning. Director Ron G. Kush.
Here.
Director Larry Russell.
Here.
And Vice Chair Monty Schmidt.
Here. Okay, could I get a motion to adopt the agenda?
So moved.
Second.
Are there any comments on the agenda?
There are none.
Okay, fantastic. With that, we'll move on to approval of the minutes.
You need to approve the.
Oh.
You got to
I need
vote.
the roll call.
Oh, sorry. Yes, sorry. Roll call.
Director Kush,
Aye.
Director Russell,
Aye.
and Vice Chair Schmidt.
Aye. Okay. All right. Then we'll move on to number 1 on our agenda, which is approval of the last meeting minutes. Do I get a motion to approve?
So moved.
Second.
Okay. Are there any comments on the?
There are none.
Okay. Then can we get a vote?
Yes, Director Kush,
Aye.
Director Russell,
Aye.
Vice Chair Schmidt.
Aye. Okay. That brings us up to our next item, which is our monthly financial update.
Good morning, Director. Good morning, Directors. My name is Brett Uppendahl, District's Finance Director. First item here today is our monthly financial update. And I will say that this month's report is a little different than the ones we typically see throughout the year, in that we only have 1 month of data, right? And so we have 1 month in July of data. It really only represents about a half of our full billing cycle. So I'm not going to spend a lot of time on the revenues and expenses. More so, I'll talk a little bit about how we ended last year and some of the water consumption trends. And we'll do a brief update at the end here on our retiree liabilities, as we've gotten an update from CalPERS. So first slide here in front of you shows last year's water sales revenue. And again, we were tracking this pretty closely throughout the year last year. And this basically just confirms kind of the trend we had the last few months here towards the bottom of the screen. We finished up at 80%. 80% of our budget in terms of water sales. That's the most variable. That's the most consumption dependent. And so you can see here in the budget to actual columns throughout the months, we did start a little kind of closer to the budget in the first and the middle part of the year, and that trailed off towards the end as we had, the late rains and the more cool spring and whatnot. So you see the 76, 70, 70, and then 77% to end the year. So that essentially became kind of a headwind against some of our revenues. And we ended up right at this 80% of total revenues forecasted, which again is in line with what we had for our 20% reduction, essentially the inverse of that as we ended the year. So again, in line with expectations, but just kind of rounding out the trend towards last year. Again, our fixed fees for service charges and watershed fees are much more stable. So those ended up near 100%. We still have a couple of year-end accruals to process there. So we expect to be pretty close to 100. The overall, if you add all these together, looks like about 88% of the year. I think the main thing there is you look between the water sales down here, budget and actual, it was $12 million of a gap, right? 60 million budgeted, 48 million actuals. So it's a $12 million gap. That's that $1 million a month clip that we were on for most of the year. So again, that was last year. We have a new rate structure in effect, and we'll have more information on that in the coming months as we start to get a couple billing cycles in. I think what we look at closely probably this time of the year, and as we start to forecast towards the end of the year here, would be our consumption in terms of acre feet. And what I'm showing here on this chart is last year again. Last year, kind of continuing the trend. We have a 10-year overall pattern here. And I have the dotted lines across the top of the 10-year average. You can see in fiscal 1920 and fiscal year 2021, we were well above that average. And then obviously 21-22 being the low point at 19,000 acre feet, well below the average. And then 22-23, as I was indicating in my prior slide, was really just a slight uptick, but actually very close to that kind of low value of 21-22 being the 19,100 acre feet. What I found interesting when I looked at here, and that's why I've shaded the two colors here. The first color, the darker color at the bottom, is our first 6 months of the year. And then the lighter shade blue at the top there is our final 6 months. So in particular, looking at 21-22 and 22-23, the most two recent years, you can see the first 6 months of 22-23, we actually did experience a little bit of a bounce back, a little bit of a return to normal patterns. In terms of having 11,000 acre feet through 6 months. And it was really this last 6 months of the year that it slowed down to having only 7,000 acre feet or 7,700 acre feet in the last 6 months compared to the prior year of 8,400. I would note that both of these are still, 10-year lows, right? 10-year lows for the first 6 months and 10-year lows for the second 6 months. So we really are kind of in this stage of, this may be kind of closer to the new normal. I think, as we've talked about through the rate cycle, it's impossible to really predict, overall usage. But I do think that we were on track with assuming for COSA purposes and for rate planning purposes that we're not going to be returning to normal levels, and we'll still be significantly below that 10-year average of 22,000 acre feet for the foreseeable future. And then this is the first month here in July. So again, we have a 2-month lag in our billing cycle. So what you're seeing here is really water that was used in May and June. In parts of July. And so this just, again, is another indicator here. Fiscal 24 is the first point of new data that we have. And you can see that it's in that range of where we were the last 2 years, slightly higher than fiscal 23, right around where we were fiscal 22. So all points are kind of indicating that we'll be right in that kind of general range of, again, well below our 10-year average, closer to that 20,000 acre feet overall in terms of a projection for the year. Again, this is early in the year. This is coming off of a historic storm and cool early summer. So we'll keep monitoring this throughout the year. We'll keep giving your board updates. But this is where we are after 1 month of the fiscal year here in July.
But thanks a lot
Sure.
for the summary. Trends continuing to hold. Looks like some combination of decreased usage due to conservation plus decreased demand due to weather patterns. And I know we've spoken a lot about how you try to estimate demands for the rate cycle going forward, accounting for changes that you're seeing and doing your best to sort of predict, guesstimate how those are going to carry forward. One question that I certainly get a lot is, how are we accounting for increased demand due to additional housing requirements? And one of my quick responses is that, well, we're actually seeing, some drop off in demand that's likely due to conservation, so that we're currently below our 10-year average. And that does give us breathing room to support additional housing as necessary. But that's probably only about a halfway good answer. I was wondering if you could just just remind us a little bit about how you thought about increased housing when you were planning the rate forecasts.
Sure.
Or the forecast for the rate cycle.
Yeah, and I think what you're getting at is one of those, the trickier parts of the forecasting model, right? Because you have 2 or 3 pretty big variables there between weather and between normal consumption and this future housing trend that we should be expecting. I will say that for the rate cycle, which was a 4-year, time horizon, we did not anticipate any additional growth in terms of overall housing units for the 4-year cycle. Knowing that the history here in Marin and in general with housing is it takes developments a while to fully be approved and to be constructed and to pass all the hurdles that they do have there. And so we chose to kind of be more conservative there and to assume for the 4 years at least that we'll have the same essentially population base or housing mix that we currently have. And then once we see more developments in that the housing kind of demands that we're getting from the state, we'll incorporate those into the next rate planning cycle. So we didn't incorporate it in this cycle.
Okay. And of course, there's always the discussion of new supply development and how that's accounting for additional demand. So I just want to make sure that
I think I would just say on that, my understanding, and Ben or Molly can correct me, my understanding on that is that we're taking that into account in the longer term, strategic water supply assessment, the SWUSA, that is much more a longer term focus. And so, as opposed to the 4-year rate cycle, they're looking, 20 and 30 years out. And so I think it's addressed more fully there.
Yeah, that is correct. In the water supply aspect, because it is, as Brett noted, a long-term look, we did account for the housing numbers, so they are included in there.
Along these lines, I know a while back there was a lot of concern about the additional draw on our limited supplies when we were in the drought. And we we did an analysis of looking at of all of the units that are likely to come online, I think in the next 4 or 5 years, and estimated what that increased demand would be. And I can't remember the percentage, but it was like sub 1%. I mean, it was a really small number. So just in terms of a matter of scale, I think that, that increasing, demand from new housing units definitely needs to stay on our plate in terms of something we look at. But as an order of magnitude issue in the near term, I think it's a really small percentage of our overall
And
consumption.
if I can add, we do also capture that in our urban water management plans. So every 5 years, we do update those according to state requirements. And we do look at the most recent RENA numbers that have been incorporated in by the municipalities in the county. And those new units tend to be lower water use, just because the density, if the density is higher, you have lower water use and less landscaping. And we also have the new requirements that would apply to any new developments as well.
Thanks a lot. That's good reminders.
Okay, so I'm going to go ahead and transition to a different topic, the second topic of this item's report, which is our unfunded liabilities. And this came up a few times in the spring. And I told the board here I'd report out when I had more information. And so we recently received an actuarial valuation from CalPERS. And so what the gist of it is that they're looking back a year. So they're looking at how 22-23 ended, right? So it takes them a full year to bake those into our report. But they reported an investment return for this most recent year of 5.8%, which is a good return in most years. However, for CalPERS, their target is 6.8%. So this represents essentially a 1% loss from their forecast. They did note that over the last 10 and 20 year periods, if you look at it on those marks or those lines of analysis, the longer term annualized investment returns have stayed right around 7%, 7.1% and 6.9%. So I think the target rate being 6.8, that's something that was lowered, actually. It was reduced last year. And it's been steadily reducing for the last 10 years from what used to be 7.75 all the way down now to 6.8. And so they're really starting to coalesce around this longer term investment earnings assumption of 7%. I know that there's, plenty of debate about whether that's the right number or not, but CalPERS has taken the prudent approach of steadily lowering that target. And again, last year, the results were 5.8%, so close to the target, but a little below that. The second bullet point down there is that, when they actually give us our full actuarial evaluation, when they look through our costs and our employee accounts and how they expect that to happen, how they expect that to play out over the future, they're taking in the results from even 1 year before that. So fiscal year 21-22. In that year, CalPERS had an actual loss. So they were minus 6.1% in 21-22. And so that's the new information we have for our fiscal kind of impacts. And so when they have a loss of 6.1%, the impact on our rates will be phased in over 5 years. They have a phase-in approach, right? Whenever they have an investment gain or a loss, they chop it up into 5-year kind of tranches and let us pay that off, the impact over 5 years. So it's never one big shock to our budget. It does smooth itself out, and you have kind of competing layers, between the years of gains and losses. But ultimately, it does kind of come down to how well our pension plan is funded. And so the bottom bullet point there says that we were, prior to the last report, we were 71% funded. And then with them having this loss of 6.1% in fiscal 21-22, that pulls us down to a 62% funded ratio. And so this next slide helps explain that in a chart form. And so the green bars there are the CalPERS investment returns. You can definitely see the ups and the downs in the last, 5 or 6 years. Plenty of years above their 6 or 7% target, including the COVID year, which was a kind of a surprise there. The year after COVID, a 21.3% return. And then we had the -6 and the 5.8 that I just pointed out. And I've plotted across the top there MMWD's percent funded, so how our portfolio essentially is performing. And you can see that it ties almost directly to CalPERS' investments, right? When CalPERS investments go up, our funded status goes up. When they go down, our funded status goes down likewise. And so you can kind of see that long-term average there is steadily staying between 60 and 70%, kind of the mid-60s if you had to do the math on it. But again, this is just more of a kind of an informational update. Most all of this is beyond our control. When CalPERS implemented PEPRA back in 2013, it really took all of the local control away from pension funding, and so we're kind of just at the mercy of CalPERS for most all of our costs here. So it's good that we look into it, understand it, incorporate it into our projections. But this is really just informational for the board at this point.
How many dollars is it?
Dollars is
Dollars that we're at 61%. What does that mean dollars wise? Like
Uh,
10 million and 50 million?
so for pensions, we have $117 million unfunded, right? And so basically we have an account with them that has our balances and
I
our future
understand that
liabilities.
side.
So 117 is the delta.
And as I recall, they charge us interest, right?
Yeah, I mean, they apply their discount rate to kind of both sides of the equation. So they apply it to what we're underfunded at, and they also apply it to if just the future growth of the stock market. So just so that the two lines go together between assets and liabilities. But yeah, they give us a nominal discount rate on this unfunded liability.
So are you going to think about a plan to move that forward, or?
Well, like I said, it's a lot of this is beyond our control, and it's more of a long-term kind of strategy we have here. So I think in times of surplus, we may talk about how to best invest our surplus funds if it can impact this. I think there are some agencies that choose to try to pay it down sooner. I think for agency our size, I think the slow and steady wins the race here. We just want to make sure we're on top of it, make sure we understand it, and don't have anything hit us by surprise. But I think it's something that, like, again, if we have times of surplus, we can take a deeper dive into it on how to maybe best apply our funds rather than just making 3 or 4% in LAIF, as I'll talk about in my next item. I think potentially you could make more here. You could lose more, obviously, but you can make more here in terms of putting our assets to use. But at this point, it's just informational.
Brett, can you, sorry, Larry.
Go ahead.
Thanks. Brett, can you say a little bit about the practical implications of having an unfunded liability? So my starting point is that it means we have to cover pension, and if we have unfunded OPEB liability, that through our operating budget. Can you talk a little bit about the relationship between the increase as liability increases? Does it impact us immediately, or is it something that is an issue for down the road when we start to see more retirement? What is the consequence of having this unfunded liability?
So I think, so the idea here is that in the mid 2000s and certainly through the Great Recession, industry-wide or kind of across the country, pension funds became kind of a target in the sense that, when investment returns, as you can see on the far left of here, when they're in the -10s and -20s, it really throws a monkey wrench into, long-term funding. And so I think a lot of agencies were cash funding it, meaning that each year you just pay what you need to your retirees, you just pay it each year. And I think because of the way the losses happened, between the dot-com losses and between the financial crisis there in 2009, the actuarial agencies and the best practice and the GFOA and GASB, which is the Government Accounting Standards Board, required local governments to report on their unfunded liability so that it was taken into account. Because at the time, there was a bunch of different structures you could have for both OPEB, which is retiree health, as well as pensions. You had a lot of different structures, and it made it hard to kind of have an apples to apples comparison for credit ratings or for anything else. And so they were standardized how government agencies have to account for their unfunded liabilities. And with that, they also kind of created the standard you should be putting money away for future liabilities, because with the baby boomer generation kind of retiring out, the longer term costs were much more than the shorter term costs, right? You may think you're okay at a couple million a year paying your retiree liabilities, but in 10 years, that's going to be double or triple. And so that really kind of set off the practice of putting money, ahead or more money ahead and really reporting out on the unfunded liability. So to answer your question, there's this amount that's out there that's amortized either over a 30-year or 20-year period. And you kind of try to shoot for that target of, I'll have that paid off like a mortgage, in 20 to 30 years, except for that's a floating target. So, in bad years that you have to cover more, in good years you cover less. So you're kind of always changing your trajectory slightly to get to that point in 30 years. And so it's a gradual change on the budget, but it is something they account for each year. And so, for instance, in this year, you're seeing on the screen, when our funded status goes down, CalPERS will require an additional payment from us, in order of magnitudes of a couple $100,000 up to $1 million or $2 million, depending on how good or bad the year is. And so they'll make you start to, inch up your contributions again over that 5-year smoothing period until you're on a level funding period again. But it's always changing. So we're just having to kind of keep in mind where we're at and where we think the next 2 to 3 years will be, and just never get too far out of line out of what it would be a 30-year, essentially a mortgage or a funding plan, to make sure you have enough money in, 20 or 30 years to pay the liabilities you're incurring today for our workforce.
So just quick follow on, Brett. If we had no unfunded liability today, that means we would not be making payments to CalPERS to cover retiree and OPEB costs. Those would be covered entirely out of the invested funds. Am I right there? Or?
So I think it's a little bit different on the two sides of the house. I think with pension liabilities, with CalPERS, we have two payments we make to them. One is called our normal cost, which is the cost we have to put away each year for our current staff, so to save for the future. And then you have your unfunded liability, which is a separate payment that is kind of capturing all the prior costs that'll come due. And so in that case, if you had no unfunded liability on the pension side, which is what we're looking at, you'd be paying only the normal cost, which is a fraction of the total, a third maybe of the total. On the retiree health side, we are investing in a trust fund that we kind of are holding, right? And so the trust fund, you invest each year in the trust, and you also pay out your monthly expenses for your retirees. If the trust fund were to be fully funded, as you're saying, zero, unfunded liabilities, you'd be pulling money from the trust in addition to maybe making a nominal payment, out of your cash. And so you'd be able to use that trust fund and the interest earnings there to largely offset what's due to the retirees each month. And so it really is just a balance over time and kind of the projections for, whether you're funding it out of a trust fund or whether you're paying it all out of your own, cash proceeds. And the idea is the trust fund can grow at 6 or 7%, and that should eventually grow large enough where the interest earnings pay for themselves. And so that's the goal there, is to be well funded on the retiree health side so that you can start to use your investment trust to your advantage. For CalPERS, it's more of just keeping pace and trying to get yourself, trying to take that advantage. You're trying to strike that balance between our normal cost or year-to-year costs and kind of the longer term, unfunded, liabilities that we have on the books. And so I think it's two different strategies. To the ultimate goal is trying to minimize the costs. And I think in my perspective, the ultimate goal is just trying to understand the costs and make good decisions going forward based on, the cost, that will be in 20 or 30 years, and not just a short-term 1 or 2 year look type of a thing.
Keep in mind that all of our expenses going forward are unfunded, like power bill, just a simple-minded one. So unfunded stuff doesn't mean as much as it might. And I just looked up what Social Security's number is. It's 93 trillion, putting things in perspective. So they're like minus 400% Social Security, whereas we're talking about 61% there. It is a soluble problem if we wish to solve it. In other words, that's what we put the 2 million away for. There's a reserve 2 million for that purpose. I think it's worth considering in the long run funding that, mostly because it takes away a hammer from the ratepayers, so that you say, well, we've resolved this issue. I would think this is one of the most touchy subjects we have, because people feel that, salaries are one thing and retirement's another one. And I'm sure you'll remember my conversation previously where I was having breakfast with this individual who was complaining about the retiree, which, as I recall, Ben, I don't know if this, or Brad, if it's the same, it was 61,000 was the average or something like that.
The average retiree pension, I believe, is around 45,000.
45.
Mm-hmm.
And this is the guy that then said to me, well, I'm going to have to sell my second jet. So, in perspective, but it is a touchy subject. You've heard Clayton Smith yapping about it. That we need to share the pain, or something to that effect, that he uses those words. It's a tricky one.
Thank you, Brett. I just want, since we're making comments from the board here, I just would say I think as we launch into a new fiscal year and under a new rate structure, I think it's going to be interesting to see just how things play out. I'm really encouraged in some ways that our while we sell less water, again, we're in this the most oddest of businesses where we're encouraging people not to buy our product in order to be good citizens, to conserve. And so we're seeing the projections that we built our budget around, which is, so we're no longer experiencing multi-million-dollar, or million plus losses a month. We're now in line with things, so that's good. So I think there's that you could look at those numbers and say that that's bad, but that's actually now what we've planned for. So I think that's us being right where we hope to be, or we expected to be. So it's great. I do think that the unfunded liabilities with our pension is something that we should keep an eye on. And at some point later in the year, as we see how our budget's playing out, I think if there's something that we can do to start addressing that, if we do have a surplus, that'd be something to hear your thoughts about how to proceed. Are there any other board comments?
Yeah, I don't know how you derive that last piece of that equation. I didn't read that out of those charts. We're still down from our projected to our income.
So we're talking about water sales now, back to water sales consumption. So President Schmidt is correct in the sense that we revised our long-term projections
that.
down significantly. I think as of July, 1 month into it, we're 2 to 3% below where we'd expect to be. So much more in line to the comment of, we're, it's not a panic anymore, but also we still are below where we thought we'd be. So it'll take a little more time to kind of get back up to where we thought we might be at this time. But 1 month of data is hard to really, make huge conclusions from. I was just kind of saying the trend is continuing and we're in a much closer line, much closer range, I should say.
Need more days like yesterday than today.
Okay, no other comments? Do we have public comments?
There are none.
Okay, this is just an informational item. Okay, moving on to item number 3, our quarterly investment report.
Okay, and then this is just a brief item. And again, just to remind the board, by our policy, each quarter we do report out on our investment returns and activity. I don't have a slide here, but I'll just kind of highlight what's in the report. Again, we have pretty much all of our funds in LAIF, which is a kind of a very conservative, California statewide investment pool of essentially, 70% treasury bills or 65% treasury bills. We have about 65 million or 67.5 million on deposit with LAIF. For the fiscal year ending in June, we had $1.3 million in interest earnings. And so that was a very good return for us. The prior year, we only had 317,000. So essentially about quadruple the interest earnings in 1 year as a result of all the rate increases done by the Fed. Our effective yield for investments in June was 3.17, which again is about 4 times what it was the year before, and it was about 0.8. And as the monthly difference is even more. So 0.37 was our, last year, June, a year and a half ago, June, effective rate. And again, that increased to 3.17 this last year. So all good news, getting 3 to 4 times the investment earnings we were in the low market. And from all kind of indications, the higher interest rate market should continue this year, until we start seeing cuts. And even then, because of the way that the layering is within LAIF, it'll be kind of a very, kind of gradual decline as kind of the maturities start to unwind and cycle out. So we expect to be, in this general range for the next 2 to 3 years. And so that's all good.
Yeah, it should be better this year, huh? I mean,
it should be better, starting to flatten out. But I think, if our cash stays the same, we'll probably see incremental rises, but in that 1.3 to 1.5 range, most likely.
Yeah.
Okay. Any other board comments?
Are you going to talk about alternatives?
Not at the moment. I was just giving a report out on
Okay,
investments.
well, as you know, we've talked before about Ginnie Mae. It's interesting.
Yeah, I mean, there are ways to take on more risk and to try to chase more, kind of return. I think, at this point, I feel comfortable keeping it mostly in LAIF. And I think, again, if we start to see times of more surplus, we really get into a kind of a decision-making, mode as we see rates going down, as we see other investment, vehicles being there. I think we can start to do that analysis. I just kind of figure as things are going good with LAIF and as we want to kind of maintain this kind of conservative approach to protecting the assets that we have, staying in LAIF is not a bad bet for now.
Yeah, and for information, I kind of think of it as a CD.
Yeah.
Leaf.
Yeah.
Put things in perspective and the kind of banking that we know about personally.
Yeah, it's very similar. Yeah, it's a mix of different maturity CDs. Exactly what you're saying.
Yeah, I mean, the conservative aspect of it feels appropriate in many ways because we don't like the thought of taking risks with assets that we've collected from our ratepayers. At the same time, like looking at inflation being dramatically ahead of what our returns are, we're reducing our losses, but we're not keeping pace. Is the way I look at those returns. So it's troubling to think that we're not at least holding steady.
Just keep in mind that inflation and interest rates are tied directly together.
Mhm.
So, you know, you're seeing the reflection right now in the,
Mhm.
I mean, you know, it took down Silicon Valley Bank
Mhm.
because the idiots didn't have a hedge against they never envisioned this happening. That they would hold a solid asset like treasury bonds and then it sinks them in the end because they can't get away from them.
Mhm.
Yeah.
You know, so.
Okay.
And I would just say, you know, according to our investment policy, I think, you know, as I'm looking at it here, and we'll talk about the next item as well, but the number one primary objective is safety. The second is liquidity, and the third is return. So I think we, you know, based on board policy, we try to go that way: safety, return, or safety, liquidity, then return. And LAIF fits all those, you know, very well.
Just remember, we lost $1 million to Lehman Brothers, who was all categorized as safe in our system. You know, it was a gold plus standard,
Mm-hmm.
and they still went down, and we lost $1 million.
That's right.
Okay. No other board comments? Any public comments? Okay. Moving on to our final item here, our financial policy review.
And let me pull up the screen here. Sorry. Yeah, hopefully you're seeing that now. And so again, this is another informational item this morning. And this kicks off what'll be, you know, a series of 2 or 3 items on this over the next couple months. Really kind of taking a deeper dive into all of our fiscal and financial policies. So my goal today was just to kind of really introduce the 4 policies that we'll be talking about, kind of review some of the concepts we went through during the rate cycle and planning, and really take feedback from the board to inform kind of next steps. And so as you'll hear me talk about today, this is really just more informative and kind of, you know, general context setting. I'm not proposing any changes today, but I will come back in the next month and the month after that with recommended changes to either language to clean it up and or to actually policy, you know, targets, you know, as informed by the board as we go forward. So I'm happy to take any questions along the way or any feedback. I do have about 20 slides here. So, and you know, many of them are review slides, but I did just want to kind of reset the context here and provide the board with a chance to ask any questions.
But before we start, how frequently do you do this type of, or do we do this type of review and update of the financial policies?
I don't know that it's necessarily, you know, as comprehensive as this that we go through and review them. We have a couple policies that are required within the policy to review them each year. And so we did that with the investment policy a couple months ago. I think within this, we'll have a chance to kind of refine that if we want to. But I think this is all just really in context of, you know, we have new board members, a new rate structure, a new budget structure, new finance director. And so I think we all want to take a look at this and just make sure, you know, we're looking at it with the same eyes and make sure it still works for the organization here today. You'll see as we go through each policy, and I've attached them to the staff report, they've all had various revisions over the years for different reasons. And so I think we've, you know, kind of, you know, nibbled around the edges when needed and when legally required to, or when we have to. I think we made significant adjustments, but each of them in terms of a comprehensive review, I'm not sure we've done that in the last couple of years.
It's a good question. Many of our policies, not necessarily financial, but inclusive, it's really been quite some time since we've updated it. Most recently, we've tackled our personnel policies and updated all of those. We tackled board policies, much of them, and developed the handbook. And now we're looking at updating financial policies. But And I'd say best practice is establishing a cyclical review of all your policies as well. So we are thinking about that as well.
I think that's a great idea, Ben. It's just, for us to, if we were to develop and just have on hand a cycle, a schedule of when we come back to these, then anybody can look it up and know when we'll come back to it. And we keep it on a regular schedule.
The debt service coverage, I can get to that, but on a budget basis, it's a little bit over 2.5 right now on a budget basis. Okay, so overview of the presentation today. Again, we'll kind of give a general overview of our fiscal policies, some of the professional associations and best practices we try to follow and use their guidance. I'll talk about the main 4 financial policies that we have there: reserves, investments, debt, and rates. And then I'll start to get really into reserve targets, because that's the first one I want to kind of take a deeper dive into. And just kind of review where we were in the rate cycle and start to review our current balances and where we may want to be. And what I would say with this too is that this is really a long-term look at these policies, right? Nothing has to change immediately. I think a lot of this will help inform the next rate cycle and or the next budget cycle. It may, help inform or help, guide us in the meantime, but a lot of this is really long-term focused and will be embedded into longer-term planning from the fiscal side. But nonetheless, we'll start on this here today. So fiscal policies, best practices, and industry guidance here. So the GFOA is it's actually America and Canada association. It's been around for years. They give guidance for local government, specifically for financial management. And so they have best practices, they have policy guidance, they have a lot of training documents on the areas I've listed there: accounting, budget, capital planning, risk management, and IT. Another agency we look to is the AWWA, or the American Water Works Association. They do have kind of aside from all their operational guidance they give us, they do have benchmarking surveys and fiscal, policy guidance and fiscal management guidance for us. And their focus areas is specifically on water and wastewater utilities. So it's really good to get kind of an apples to apples perspective from them. We also look sometimes at the California Special Districts Association, knowing that we do have our own, kind of environment here within California and being a special district ourselves. ICMA there at the bottom is also a good resource, International City and County Management Association. And then sometimes we look also to the Water Environment Federation, as they do have some guidance for water industry. So just again, background for where we're looking when we look for industry guidance, it's typically those 5 agencies or associations. The 4 policies we'll talk about here today, in terms of just kicking them off, are listed here. Investment policy, which we just referenced in the last item. The kind of the summary things there are that we want to maintain, practices that are prudent and systematic. The primary goals are safety, liquidity, and return. And then within that policy, there's a whole host of permitted instruments to what Director Russell was just referring to. There are various ways to get kind of that match of safety and liquidity that are required by our policy. It's just the risk associated can be widely different. There also are reporting requirements within this policy, and that's why we do the quarterly report to provide the board and the public a full transparent look at our assets and our investments. And so those are things we can take a deeper dive into in the coming months. We also have included this year, we don't talk about it much. We have a policy called our rate review policy, board policy number 45. And that just requires staff to have a regular and routine review of our rates. It doesn't require that we have a full-on COSA or a full-on outside study. We just need to make sure at least every 2 years we're looking at a rate structure to make sure it's meeting our needs and making sure that we don't need to go out and perform another full-on analysis with a consultant and or change anything. So at a 2-year minimum, and then the policy actually states, and or with the adoption of the budget, we just need to make sure we're taking a look at the rates and making sure that is fulfilling what we intended it to intend. We obviously did that in this last year, and we'll do it again, at least a cursory review as part of the next 2-year budget, and then we'll get it ready for the next COSA process in 4 years. Reserve policy, and that's what we'll spend more time on today. That prescribes the minimum balances in 6 different reserve funds. And so I'll go into more detail here in a minute, but within our overall reserves, we have 6 different sub funds or 6 different categories that we have language around how to fund them. And then debt management there, number 51, that'll come into play in the next couple of years as we start to go out again to the market to get bond financing for some of our larger projects. And so our debt management policy is pretty thorough. I highlighted the 3 main pieces of the policy there that we want to maintain the highest possible credit ratings, and that's a AA plus. And I would say that, that is obviously an incredible goal to go for, and something that we strive for in all financial management. And it could be pretty much, you could put that into our reserve policy and into our rate review policy as well, in the sense that they all kind of work together to maintain a credit rating, right? It's not just our debt management, it's all financial practices to receive a good credit rating. It also prescribes a debt capacity of 4 times our operating expense, meaning a self-imposed limit of total debt outstanding to be no more than 4 times our current operating expense budget. And then a debt service coverage, or a DSC, of 150%. Most of our bond covenants require 125%. We have an internal policy requiring over 150%. And that just means, do you have enough money to pay your debt service? And then do you also have some extra on top? You're not maxing yourselves out just to pay your debt service each year. So that's a way of saying you need to make sure you have some level of surplus each year, that you're not, again, maxing out the finances just to pay your debt service.
Are you happy with those?
I mean, generally, I think they're good guardrails. I think, I think this board and then this agency has put a lot of thought into the reserve policies, or, all of our fiscal policies. So I don't have a problem with those at all. I think they're great guardrails to have. I think it'll be more interesting as we get, further along the water supply discussion, as we start to get closer and closer to those guardrails. Are they still, as effective when you're out at the far end? The more we're kind of in the shallow end right now, as we'll talk about later. But I think in general, they're good guardrails to have. And so I'm putting this here in the next one as well, just for context again. I think we saw this, quite a few times during the rate setting process, so I won't go into it too much, other than to say that with this and the next slide as a reminder to me as finance director that, we do have unique, characteristics of our operation here. The 2 most unique ones to me are that we have our own watershed we have to also invest in and protect over the long term, and our own water treatment plants. And so with that, not only, do we have to make sure we're putting enough money aside to be, responsible owners of those, but we also don't have, reliance on the state water project as other cities and towns do. And so we're kind of really, self-reliant in many ways, and we need to make sure we're kind of accounting for that in our overall risk profile. And so it's not like we have a lot of other ways of bailing ourselves out in the future if we don't have the self-funding here. So I think that, as we start talking about reserves, especially, but, our risk profile would probably be increased in certain areas because of the fact that we have a watershed, water treatment plants, and, limited ability to be able to kind of backfill if our own equipment fails. Other kind of unique characteristics as we talk about, our risk profile and how we match our reserves, especially with our risk. I've highlighted here again, similar slide in the past, but the first yellow arrow there, the fact that we're a municipal utility, Prop 218 governs our rate setting process. And what that just means is that if we have to make a change anytime, we have to go through that process to make a change. So we can't just make a change immediately. It would take, following the Prop 218, not only timing process, but also, how we're using the money that we're raising and how we're justifying those funds. And so it's a bit of a circular, kind of a chicken and an egg thing, but just recognizing that it's not just, there are many regulations on how we can go about raising additional funds if we need to. The topography line there, again, just reminding everybody that we, based on living in Marin here, we require more infrastructure, just to get the water, up and down through our service area. And that just means we have, a higher percentage of infrastructure. May mean we have to, hold more money aside for not only the higher percentage of infrastructure, but the age of the infrastructure. So again, a higher risk profile than maybe other agencies may look at in terms of their what's in the ground underneath their feet. And then, as I mentioned in my first comment, that the final arrow down there, we have a local watershed management and water treatment operations. So we need to make sure we are funding it properly and having the right amount of reserves to make sure we can keep the water flowing at all times. So just 3 reminders that kind of build into the risk profile for what would be a reserve policy. Many of our fiscal policies have links to the overall budget, meaning that, as I mentioned before, 4 times the operating budget is our debt capacity. There's debt service coverage that kind of have ratios that go into our operating budget and our total debt service. So this is just context again, $142 million budget, about 100 or 104 of that is our operating budget, a little under 10 million currently for debt service, and a capital budget of 32.9 million that is funded by fixed CMF and also variable rate revenues. And then, as I alluded to at the beginning, this last budget structure and rate structure, the district did change the overall kind of mix of fixed fees and variable revenues. And so in 2023, our rate structure became more dependent on variable water sales, so increasing overall risk. We did add drought rates, which would overall reduce kind of the risk in the long run of falling too far behind. And as we'll talk about there, that really helps us, once we get past that 20%, kind of reduction in sales. So the first 20% is up to us. And after that, we can start to use drought rates to kick in. And then we did, the majority of our budget increases were for water supply and capital projects, as well as overall inflation. And so that does kind of, again, change the mix between capital and operating, as well as between fixed and variable. We're now at 95% fixed expenditures. And when I'm talking about fixed, I mean in relation to water use. And our revenues are now 65% variable, which means they're highly correlated to the amount of water that we do produce here. This is a kind of a general chart showing that last year's budget structure was a 55% variable in terms of our rate structure. That has now increased as we've converted some of our fixed fees to variable fees, and we've used the variable side of the house for some of the bigger increases. So just a long way of saying we've got a little bit more dependency on kind of the day-to-day changes in consumption. In terms of water sales trends, we've talked about this many times, but this completes the last year or so of projections. So we saw that in times, if you get, again, the rate cycle here to me plays a big piece in this, in the sense that the rate cycle would have been the last 4 years on the chart you're looking at here, from fiscal year 20 to 21 to 22 to 23. The first 2 years was largely in line with where the budget was. And then we just could see the last couple of years how quickly it can fall out of line. So this just speaks to the risk of if your assumptions in your rate cycle are off, this can be an outcome. And again, we have drought rates that'll help us this time around. But $24 million over 2 years is kind of a general point in time for how much financial risk we could have here at the district. We did offset some of those losses last year by expenditure reductions, both in terms of keeping positions vacant and in terms of delaying capital projects. Again, short-term solutions for this kind of risk mitigation. But we did have to use our reserves to backfill this. And so that's really what we're talking about, is now that we've used reserves for 2 years, is what's the right target for building back those reserves as we go forward. This is our reserve balance over the last 4 or 5 years. You can see that we got up to about $70 million in discretionary funds there in 2020 and 2021, and which we'll talk about, was that the right level, and should we shoot to get back to that level again? That, as you can see, due to lower water sales and having to spend more money on pumping water in, that declined from 70 million in 2021 down to about 46 million here this last year. So again, that's the reserve balance going down as we had to use reserves to backfill operations. And so I think where I wanted just to remind the board here is that this is kind of where our policies bring us. So if you read our policies or our fiscal policies on reserves here, these are the 6 accounts or 6 kind of funds that we have in our reserves. The 2 on the top there, we haven't spoken about a lot here in terms of with the board. So I'll kind of go over those more in depth here right now. We have an insurance reserve, which by our policy says we should maintain 6 times our self-insured retention, SIR. So we went and added up all of our individual SIR amounts. And so that would come up to an $18.6 million target. Currently, we're holding 6.2 million there. That is one area I think we probably would need to think about changing. As I talked with our finance manager, as well as some of our outside, kind of advisors, the chance of hitting 6 times your self-insured retention across the board are pretty low, right? Even over a 4-year rate cycle. So by policy prescription, $18.6 million for the, possible event of having an insurance, deductible kick in is probably a bit much. And so I think the $6.2 million level we have it now has been consistent, for the most part over the last couple of years. So in practice, we've been holding it at around that level anyway. And so I think we would want to probably recommend bringing the 6 times target down. I'm going to stop here for a second, just reiterate that these policies are for minimum balances, right? I think we can always have an aspirational or kind of a goal target, but when we set our policies, if we're saying they're minimum balances, we should really talk about what the minimum should be, right? And so it seems like in some areas, some of the language is written to be more of a goal as opposed to minimum. This would be one that I would think it falls in that category. Workers' compensation is determined by an actuary.
Sorry, Brett, if I could just interrupt for a minute. When we set a policy target, for example, on insurance of 18.6 million, we're currently at 6.2.
Mm-hmm.
Is that because, we have not been building up that reserve at the rate needed because we just haven't had the funding to do so? Or I mean,
Yeah, I don't have a great answer for that. I don't know why we've kept it that level. I think it's because that's just a much more practical level to be at. I think, looking at this year over year over year, I think holding $18 million in kind of an untouchable account just didn't seem practical. And so I think this probably should have been updated in the past, and it's never really been, it hasn't been top of mind as far as I can tell. But when I'm digging into it now, I figured this is the time to talk through that and maybe reset that a little bit to be more practical.
Yeah, I agree with that. You might just remind us what the SIR is, otherwise
Yeah, sure. So the SIR right now, I do have that here.
500 or something, right?
Well, so I'll say this: we have, with our insurance, we have 6 or 7 different main lines, right? Property, we have liability, we have workers' comp. So we have 4 or 5 different areas where we're insuring ourselves. And we brought this to the board 2 months ago, so I have it here in front of me. Our SIRs, $500,000 for liability, and then for workers' comp, we have $750,000 per each accident, $1.5 million for a presumptive claim. With property, our SIR is $1 million. So you start adding 500 plus $1.5 million plus $1 million, down the line. Other ones are lower. Our pollution and our auto are like 25,000 each. But the big ones, workers' comp, property, liability, those start to add up pretty quickly. And I think they are about 3.2 million now. So I think we have about two times our SIR as opposed to 6 times our SIR right now is where we're about at. And again, this would be for us to pay a deductible if we have a large event, so their insurance can kick in, right? And so the insurance would cover the rest on top of this, but we'd have to meet that deductible amount. And we did get an analysis from our insurance brokers this last week, and we have come nowhere near to needing to kind of tap into these deductibles. We've had small claims and small damages, but we have not had to go in anywhere past our SIR since 2017, and even that was a minor kind of incurrence into that. 2011 is the last time we had a major kind of use of any of our deductibles, and so over 10 years, we haven't had much experience or need to do that. Again, that kind of speaks to maybe 6 times as a too high of a target type of a thing.
Is there any sort of, sorry, we're jumping in here, are there standard practices of other water agencies or agencies similar to ours in terms of their SIR?
We're looking into that right now. So I don't have that now. I
Okay, great.
assume there are. I'm not sure if they get that specific in this particular one. I've seen more so where actuarial evaluations are used here, and they'll give you a target. Just to kind of pick a random 6 times SIR seems high, but I will look into that in next month's report out.
Yeah, you'll find that it's a high variability because some are self-insured,
Yeah.
and we're self-insured in workman's comp. I don't know how common that is.
I think it's common because I think it's hard to get anyone to insure you anything reasonable for workers' comp. Other than the individual kind of incidents, but in the long term, they can add up, quite a bit. So workers' comp, as you mentioned, we're self-insured. And so we have an actuarial study every 2 years that looks at all the experience claims we've had and projects out what all the losses would be. And so they give us a number that we should hold aside to kind of account for the expected loss over the future. So this is kind of like an unfunded liability question, but with workers' comp, you never know when they're going to be coming through. And so we hold what the actuaries tell us we should prudently hold, and that's currently 6.6 million. Again, that's just part of kind of running a good self-insured retention policy, and we get it reviewed every 2 years. So I feel comfortable with that target. Capital reserve, you'll see there, the current policy language is that we have enough for our annual budget of capital expenditures. And so currently our annual budget, with this last year, increased from what used to be around 20 million or 25 million up to 33 million. And that's going to keep on going up, according to the budget we have and the rate structure we have in place. So that number will keep going higher. We did, choose to use reserves in the last couple of years to keep our capital program going and to kind of help, mitigate the short-term, revenue losses. So we have kind of drawn that reserve down to just under 6 million now. And so I think this is one that we really should take a closer look at. I think, between this and the operating budget below, they kind of can interplay a little bit. I think there certainly is some prudence for having levels of capital expenditures kind of always around in case you need to make quick fixes, or if you need to, be able to make a grant match, or if you want to be able to do a pilot project or something like that. So I think having a balance is there is obviously a very prudent idea. Whether we need a full annual budget set aside, maybe something, we might want to take a look at. Maybe it's, half the budget or a certain amount. I think this policy, if I was to guess, was probably more applicable when we were kind of more bond funding as opposed to cash funding our capital program. You probably always want to make sure you have a full year left, while you're going out to raise more funds again. Now that we have a CMF and we have some rate revenues in there, there may be some reasons to tighten that one up or kind of slim it down a little bit. And so I think again, we'll look at some of our comparable agencies and we'll really take some input from the board here and come back with a recommendation next month of what we think would be the best level to shoot for over the longer term.
Well, good luck. I've been futzing with that for 19 years and have not got a definitive answer yet. Because I don't know that the number is definable. It's more a judgment call.
Mhm.
And it's, for lack of a better term, fairly arbitrary.
Mhm.
So, I think it's more what people feel like is a good number than it is someplace you can actually look up or see it should be this.
In my experience, this is unusual to suggest you're going to have a reserve at the same amount as your capital budget. Doesn't really make sense. And Brett indicated the possibility to look at the capital and unrestricted reserve as one bucket, which probably really gets to the need. How much cash on hand do you need under different risk scenarios, and think about it in those terms. But we'll come back with some thoughts on how to deal with this.
But putting it in perspective, the city of Tiburon is 300%
Yeah,
in reserve.
right.
So,
Mhm.
it's debatable as to what the right number is, depending on what you see the future, as best you can see it.
So under the unrestricted operating reserve, that's the one there in the middle, 6 months of our annual operating budget. And so 6 months is on the high side, just nominally. I think, as you look around, you typically see things more in the 3 month or the, 1 to 2 month range. But I would say that as we looked at this, we looked at this one pretty closely in the rate setting process. It really is, that one depends on how else you're structured, how your budget's structured, what other reserves you have. It's not just a cut and dry 3 months of operating costs. I think that's kind of a bare minimum.
Your cash flow.
In your cash flow, yeah, where your risks are. So
That's what's unique about us, as opposed to somebody that's financed by property tax. We have utility fees coming in all the time. So it changes the perspective somewhat, although we saw the drop over COVID.
Mhm.
So there can be people that won't pay their obligation. But in general, our cash flow is pretty good.
yeah, in times of kind of steady consumption, our cash flow is pretty predictable. And so again, 6 months may be a bit much here, but it does depend on kind of our other accounts that we have, available. And as Ben was just mentioning, I think there's probably a bottom line number we're all better to look at there, and then kind of chop it up from there, in terms of how I like to use it. But probably the bottom line cash is a more probably more productive endeavor to look at, is where do we really need to have cash on hand. Right now, as the math would show, 6 months of our operating budget is 52 million. We have about 21 million in that account right now. Again, we're still finalizing our accounting for the end of the year, so that number may move a little bit over the next couple of weeks, but right around 21 or 22 million we have in there. So about half of what our policy would say. And again, as I mentioned at the beginning, we should be thinking about this in terms of minimum balances, not aspirational balances. And so I feel like we're right around that kind of bottom of where you want to be minimum balance now. But again, we can talk about where we want to get to in the future and how we'd want to structure ourselves for future rate cycles, for rebuilding reserves, to kind of maintain a minimum, but also have a target we're shooting for.
Brett, I think as you're bringing back decisions, it'll be really helpful if you could include in that an analysis of the key financial risk drivers. So drought, for example, other type of natural disaster, earthquake, fire, whatever it is, to understand where we can spend money to reduce risk versus risks where we can't counter that through changes in budgeting or expenditures. And those would, I would imagine, be the ones where the reserves are most critical. For example, the risk of reduced revenue during drought. We've addressed that in this rate cycle to some degree by putting in drought rates. There may be other things that we can do that reduce the risks to some revenue streams so that it helps us think about what's really needed in reserve versus having a number that's just based on an operating budget or some other less maybe scientific or, evidence-based
Mhm.
approach. So.
Yeah. I will strive to do that. It is difficult, to get a real risk analysis on all of this and kind of the 40-year, payback and all that kind of a thing. It is tough. And as Larry was indicating, I think you'll find a wide variety of, wide variance in terms of how other agencies do it. But I do hear what you're saying on that, and I will try to make sure we're incorporating that. I have a piece of it here in a slide or two, but I think it's not addressing what you're saying about in terms of guiding our investments as well as just how much we're holding aside, right? So I think those two, where we spend our money and how we hold our money, go hand in hand is what you're saying. So I will try to incorporate that.
And I do think, Director Kush, thinking about it in terms of emergencies is a good way to think about it. A challenge is, if we think about a design seismic event, we're never going to have enough money on hand to do that work necessarily. So you always want to have some debt capacity to add to your reserves in that event. And then what happens, FEMA comes in and you get other sorts of support, but you do need cash on hand to get the contractors deployed and moving and starting that initial work for sure.
Yeah, I think it's a little bit optimistic. What your concept is interesting, but the practicality of it, you can't predict droughts, you can't predict earthquakes. So Ben is exactly right. If you're going to really do it, think of it this way: Alpine Dam fails. What do? I mean, you can assess it and you can rub your tummy, but it's either it's a 0-1 kind of thing. There's no 0.6 on dam failure. It's either going to be okay or it's not going to be okay. And all you can do is do the engineering to keep it as safe as possible. After that, it's kind of in nature's hands. And it makes it a little tricky. I don't think we're going to find that equation.
Yeah, I do agree when it comes to infrastructure, there's a limit to which we can hedge against that with our own financial management. I think where I'm going though is really related to our our primary revenue source, water sales, and thinking about how to reduce the risks of drought through increased resilience and spending on resilience, as we've discussed many times, rather than saving money for, focusing entirely at least on saving money for the next drought when we won't have water to sell. It's just that it's that balance between investing in water resilience versus keeping everything in reserve for when we are again short on water. I think that's the one item that I really hope that we think about carefully.
That's a good one to think about. To me, what I've heard so far this morning is the biggest risk we have is the one that I've been trying to work out since I joined the board, which is that 65% of our income is variable. 95% of our expenses are fixed. That's the one that's screaming at me right now. I tried fairly successfully to move things along to get less and less and less dependent on variable. Now, if you go back historically in water rates and water billings, there were fixed, no meters, just fixed. In other words, you got 6,000 customers, you got a cost of $10 million, you divide 6,000 into 10 million, that's your monthly fee. And they didn't care who used what or how it was. Sacramento was the last one I remember that converted. But that's where that comes from. It's saying that, it's too hard to manage. So you just divide the cost by the number of users. And as you move away from that, and what we did to go back is we moved the other way, which was to try and eliminate that variability. And it's complicated because of conservation. If you take away the cost, then what's the incentive to conserve? And PG&E also suffers from the same problem you're talking about, that, we're discouraging people. My predecessor, Dick Hill, used to say that, we're in the business to sell water. And that's what he was saying, you know, it's like, how do you justify conserving besides in the overall public good? Resilience, it plays into that. You know, there's a value of conservation with respect to resilience. The weakness, of course, all of it is anybody can just go back to the old way. You know, not that they would, but they could. That is another risk that's very hard to assess.
What I would just say, in addition to all of what we're talking about now, is that, you know, if we do have to use reserves, a part of this is smoothing out the rate impacts, right? And so I think in this last rate cycle, that was a part of it was, you know, we had to use reserves in the meantime, and then we have to reset our budget. And then we also have to rebuild reserves. And so there's a way to use reserves to smooth out the impact on our customers over time as well. So it's not just holding it for our own good. It's almost in a certain sense to make it more predictable, you know, for our customers, so they don't have big shocks every time we have to change anything or respond to a drought. So it's normalizing our business so that we can, you know, be predictable on both sides is another goal, at least of mine, as we set up the budget structure and the reserve structure behind it.
Which is the tricky part about drought rates. There was a major upheaval in the 76 board, 3 board members gone because of instituting the drought rates. And the drought rates have been here. This isn't something new. There was an administrative problem, but the physical, from the entire time I've been on the board in 2004 forward, there's always been a drought rate. That was, that's that stuff about the 40%, 40,000 acre feet, you know, and all that stuff at April 1st. And the problem is when you institute those, that's when it gets tricky, because then you get the, I'm using less, paying more, you know, off it goes.
But I think this is the important thing that we have learned from, and what we did with our drought rates, or not our drought rates, sorry, our current rate structure, is we have, I think, made some important decisions about making an assumption that we are going to see an ongoing conservation ethic, or just change of way of life, which is continuing to bear itself out. And even though we've had now basically 2, you know, a semi quasi normal year the previous year and a wetter winter this last winter, we're still seeing consumption down. And whether that'll continue, who knows? But I think we have learned something, and that we are able to adjust, and we're being balanced in our budget going forward, and it reduces the need to institute drought rates. And I think also our reserves behave the way they were intended to, which is we use them to backfill revenue when water sales are down. And we did make an adjustment to the amount of our fixed revenue in this rate, in this new rate structure, because it, you know, in many ways, it also reduced that incentive for people to conserve. So now there's more of a price signal on people's bill to, when you conserve, you get the benefit more. But that's really the thing that I think is important to focus on. So, you know, we can keep thinking of twisting and changing our dials. I think we did a lot to make the right balance of strategy and fiscal management in our current structure. And I'm really, I'm interested to see how it plays out over time. I know with 1 month, one data point does not make a trend. So
Especially a half a data point.
Exactly.
The other thing to keep in mind is that these were always called drought reserves. Historically, 80% of my career, they've been called drought reserves. And only in the last 10 years or so that the wording has changed. And so the problem has existed for all water companies, especially in semi-arid places like California, always have been around. And call it rate stabilization, call it whatever you want to call it, but that's what they are, is you push money in when you don't have water to stabilize the rates. That's the task. And it's, you know, it's a strategy. I don't know if it's the best strategy, but it's a strategy.
And so that leads me into the next line here pretty well. And I think, you know, to your point, Larry, we have a rate stabilization fund that's set up within our reserve policies. And this one's a little bit unique in the sense that the language within our policy does not prescribe a minimum. It just says, you know, we have this here and it's to be used in times of surplus to hold money, but it doesn't really describe how we would use it either. It just says when you have a surplus, hold some money here. And my understanding is this was set up as part of a bond issuance years back, where it was, you know, recommended and or demanded that we set something up like this, you know, for drought reserves. And so what I would say is that, speaking to what we were talking about earlier about the unrestricted reserve, if that's where our drought reserves are going to live, then we don't need this one. However, if we want to have our rate stabilization be our drought reserve, then we can, have it be more, distinct. And so one of these things where, it doesn't do you any good to have a half-baked, fund in there. So I would say be more specific one side or the other. Is it going to be baked into the overall, or is it going to be a standalone account that we use and kind of manage that way? And that's a decision for us to make.
Just remember that indecision is the key to flexibility.
Yeah, I mean, in flexibility, and the board always has flexibility, and there's ways we can, we're all trying to be flexible and adaptable. But when you're trying to set policies, you try to at least generally kind of give direction for how to go forward. So this one could use a little bit of a cleanup at the very least, if not a,
I
an overhaul.
appreciate that very much. That's very useful because I am pretty pragmatic, and I get concerned about arbitrary, and especially arbitrary things that are making life difficult for no real reason.
Yeah.
So it's good that you're thinking about this, because the problem is, like I say, just keep in mind that there's no hard and fast. It will come down to us making a decision. That's all. It's not like we're not going to find the Holy Grail and say, oh, look, here's how to run a water district. This doesn't work that way.
And so just to round out the summary of where we're at now, we recently added the bottom line there, the water supply project reserve that was added last spring, kind of in concert with our rate setting process. Similarly there, that does not have a minimum balance. And I think we didn't kind of, take that on at the time. We just wanted to make sure we had a target, which is $2.5 million per year out of our rates to set aside for a future water supply project. So that one does not have a lot of language around it. And so that'd be a good chance for us to refine that here this year. Whether the target's right, whether we want a minimum balance, whether we want prescribed uses, and how that interplays with our capital reserve, not unrestricted as well. So again, more to come on that. And just, this is more introductory in the sense of where we're at. Adding those all together down there, the targets would prescribe 110 million. That seems a bit high, just kind of on the surface. Our current balance, 41.8, maybe a little on the lower side, but we can kind of talk about where we want to end up in a couple of years and how we want to bake that into our next rate cycle. But, we're about 40% funded in terms of our own policy, with the biggest gap, not the biggest gap, but an obvious gap there at the top of it that I would think of our self-insured retention, and then the capital reserve. Those are the biggest numbers are kind of playing into this, shortfall for now in terms of our overall policy. So again, this is a reminder, we want to think about minimum targets so we can, actually have a good minimum target, and we can layer in there some, goal targets or kind of rate setting targets around that. And then really thinking about the interplay of our budget structure, our risk structure, and how these accounts kind of help at least smooth out operations and minimize risk and minimize impact to our ratepayers. Talking about industry guidance, and I know we've hit this a few times, so I'll do this pretty quickly. It is a range, and this kind of shows that the top three, GFOA, the ICMA, and the Water Environment Federation. This is just kind of for overall operating reserve. It ranges from 45 days to 2 months to 3 months, and so putting that together, I would just generally say the industry guidance is 2 months of your operating budget. And recall that we have 6 months as a minimum target in our policy. And then all guidance that we get from the outside will always say to have an agency specific factor built into that. And I've mentioned that a few times: budget structure, revenue volatility, our asset condition being, what it is, and then our credit rating objective, which is obviously to maintain a high credit rating. So, when we look into here, this is just kind of unpacking that a little bit more. Our overall budget risk, within our budget, do we have, levels of contingency for water purchases? This year we increased the water purchase to not be the minimum take or pay, but to have a little bit of flexibility there. Do we have, sufficient equipment replacement funds in the budget? How volatile is our revenue? And it's going to be more volatile, as Director Russell mentioned. What kind of unplanned expenditures will we need? And this talks about our 4-year rate cycle, right? Because we have limited chances to go back and change things. Not that we can't, but to maintain a regular course of action, you have to plan kind of for that 4-year planning period. So you have your rate cycle match, what you're trying to do with your reserves. Drought and inflation, those factor into it, right? What are the impacts of drought? What are the likely impacts of inflation? Unplanned infrastructure repairs. That's one thing. Having an older infrastructure agency, we need to make sure we have funds, set aside for the ability to fix pipeline breaks or whatever may happen to our key infrastructure pieces. Do we want to have strategic, investments or accelerated investments in infrastructure? If we find a good grant, do we have matching funds for that? If if something fails, can we replace it with, kind of the modern technology, or do we have to just go back and kind of replace what we already had? Do we have enough funding set aside to be able to move forward as opposed to just kind of replacing what we already had? Emergency, we talked about that a couple minutes ago. Replacement for catastrophic events, and as Ben mentioned, that would be in coordination with FEMA, in coordination with other sources. But do we have the cash flow to immediately respond for fire, floods, earthquakes, things like that? And Director Kush, your comment on how can we invest to kind of mitigate those risks is also something we'll take a look at. And then we always
I
say
think on that one, I just want to, sorry, I know you're trying to finish us up and I really appreciate that. I think I just want to say that the emergency replacement of catastrophic events, there's also a revenue loss associated with each of those potentially. And I think that's where, when we talk about drought reserves, they're not just drought is one, environmental, event that could happen to us, fire, flood, earthquake as well. So I just think when we think about reserves, yes, we need to rebuild quickly and make infrastructure investments to make repairs, but we might see decreased revenue also during that time. So I think just being thoughtful about what we create as a reserve for reduced revenue due to rates, I think would be important to look at.
Yeah, that's a good point. And during those events, we will have less revenue coming in to the district. So that's a good point to keep the revenue in that conversation. And so finally here at the bottom is litigation and insurance reserves. And again, these are the first two I talked about with our, self-insured retention, our deductibles. And, if we do happen to need funds for future litigation, just to have those on the side. So again, we don't have to stop operations or go immediately back to ratepayers if something does happen over the 4-year cycle. So those are things you want to make sure we're keeping in consideration with the reserves. This Director Kush is something that we prepared, similar to what you were just describing in terms of a risk analysis. This doesn't have a full on, actuarial risk of, how likely these events are to occur. But I think, looking at the guidance from the big four or the 2 or 3 bigger organizations saying to do a self-assessment basically, and to kind of, decide what you may need here in your own agency. This just says, regardless of all the funds you may have set aside, what do you really need for cash on hand, right? If you needed to cover these events over a 4-year cycle without having a major impact to your rate structures, your rate payers, what may you have to set aside funds for? And so this is obviously, kind of round numbers and just kind of, relatively picking off the 8 or 10 most likely things that could happen, to an agency of our size, but kind of have them in 3 columns, the lower amount, if you want to set aside funds for the lower, end of that, medium, and then high. Budget structure, again, I kind of just went with the 1 to 3 months of operating that the minimum standards are, and then the math plays itself out there. If we wanted to also kind of have a little bit aside for, over 4 years, if we're off by 1 or 2 or 3 or 5% for operating budget, and that's mostly inflation and or, other costs that are out of our control, electricity costs, whatever it may be, do you want to hold some funds aside for that just in case, we're not perfect in our projections? Need replacement funds for vehicles and technology. Should we have some funds set aside there that in case we have a big truck or a big piece of equipment go down, can we fix that without having to, sacrifice a capital project along the way? Water purchases, since we do have a considerable amount coming from Sonoma, if they raise their rates more than we thought over the 4-year planning period, if we have to buy more than we thought over the 4-year planning period, do we have enough in reserve for that? It could be part of the drought reserve or somewhere else. With revenue volatility, I updated these numbers to kind of, reflect what we're expecting in the budget. So recall that drought rates kick in after we're about the 20% consumption stage based on our water shortage contingency plan. So to me, that means we're on our own for the first, 1 to 20%, right? If we have a 1 to 20% variance, we're on our own. So I did the first, 5 to 10% consumption ratio, and then the next 11 to 20% conservation scenario. So that's just, how much we want to put aside for if we, over the 4 years, and this is just 1 year look at it, but over the 4 years, if we start to, see multiple years of being below our projections, what might need to be in a drought reserve or a rate structure reserve. Asset condition, again, similar, unanticipated repairs. We don't know where they would happen, but 25 to 50% of our CIP might be a good indicator there. We could probably also add up the 4 or 5, most expensive, pieces of equipment that may fail. Grant matching funds, I think, are good to set aside because, again, those are, you want to be able to put funds to match a local grant or a FEMA grant or whatever it may be, a WIFIA grant, a WIFIA loan even, without having to sacrifice your capital program. So do we want money set aside in case we have a good alignment in the future? And then finally, the natural disaster and other risks. Again, these are kind of a shot in the dark for how, significant of an event they may be, but just to have enough cash on hand for initial response and mitigation, for paying our insurance deductibles, for matching a FEMA type allocation, cash flow. Even then, FEMA sometimes takes a year or two to pay you back, so you may have to cover it up front before we can go out for a loan. And then insurance claims fall into that same general risk of within our own SIR and within what may happen on different lines of our insurance. So adding these up and kind of looking at the bottom line, it gives you a range of 38 million to 110. That's a big range, obviously. The middle of that range, interestingly, 73.9 million is pretty close to where we were back in 2020. So I'll just rewind pretty quickly here, keeping that $74 million number in mind, right there at the kind of the middle of kind of our high balances there. We were in that range, right around that $70 million range. And it seems to have worked pretty well, in the sense that they worked as planned, and we were able to weather a couple of pretty significant events during that time. So something tells me that that's probably about the right range for total cash on hand to have, as an agency, right around that 70 million number. But again, there's different ways to look at that and different ways to kind of think about this pace with which we want to get there, and what's a minimum balance versus what's a goal balance type thing again. And so these are just different ways of thinking about it, different ways of kind of coming up with that range, and then we can kind of design our policies around that.
It's interesting that the 110 is about the same number that the policy adds up to.
Yeah, that's also interesting as well. Yeah, different buckets, but still gets to the same place. Yeah, you're right. That's right.
So it, maybe there was a little more foresight there, conservative as it is.
Mm-hmm.
It's just interesting to me that they hit on the same number, or close to the same number.
Yeah.
Brett, how do you well, first, this is really helpful, I think. This is sort of what I was thinking about when I brought up my earlier question. But how do you distinguish between revenue volatility and operating budget contingency and maybe even water purchase?
Yeah. So here's the way I think about it. So operating budget contingency, I think of, all the operations that we do, purchasing water chemicals, electricity, staffing costs, whatever else it may be in our operating budget, right? So to be 100% perfect in the operating budget is tough, right? So I was just basically saying, 0%, 2.5%, or 5% of our operating budget, if we were off by a little bit, in any given year. And I distinguish water purchases just because that is its own large line item in the budget. And that's one that really is it's different than just regular inflation, different than just, I had to fix something this year. Didn't know I had to fix, or had to do a study I didn't know about type thing. That is really set by the rates each and every year up in Sonoma. And so those could change, drastically over the year. So I just separate those two myself, just because I think of our ongoing operations different from how much we have to pay Sonoma for water purchases, and two completely different kind of, risks that go on there. And then was it rate structure risk you're asking about on top of that, or just those two? Because rate structure risk is the revenue. So I try to separate the expense side, right? Expenses, money going out the door, where the risks might be if we don't have a perfect plan, versus revenues, dollars coming in, where we might be if we don't, hit it perfectly with the budget or with the rate cycle. So I was just trying to separate those two. And I think, some people would say, those don't both happen in the same year, or, unlikely it all happens at once. And so I think that's kind of where we try to find that balance of, would it be off on expenses and on revenues, and have a natural disaster all in the same, year, or, 2 or 3 year rate cycle. That starts to become the $1 million question.
Okay. I think I follow that. I think that's good for now. Thank you.
Okay. So credit ratings, this is one thing I just want to add to this, and in the sense of, I know that we've talked about, striking the right balance for our level and agency specific, and, what's the right thing for our ratepayers. And it really is kind of a self-guided exercise for the most part, until we get to this part, until you get to credit ratings, right? So credit ratings is the one place we do have to kind of generally be in line with our peers and what would be expected of a AA or AA plus type of an agency. And so I think we always have to kind of check our own internal assumptions with how these numbers shake out. We were upgraded to AA in 2019 after we added the fixed revenue source for capital maintenance fee. We had good projections for consumption going forward, and so that was kind of the basis for why we were upgraded back to a AA. And we've maintained that AA since then. Credit ratings, primary factors is kind of the size and health of the overall operating system, financial strength, what we're talking about today. Rate management and regulatory compliance is a big piece there, 20% as well. And so I think, it shows well the way the board and the organization managed the rate process last year. That will definitely help with our credit ratings discussions. And then any kind of legal provisions on top of that that make us any different from other agencies. When you talk about financial strength, there's 3 measures at the bottom that I'll talk about here, just again for kind of background: debt service coverage, which is our operating surplus and divided by our total debt service payments each year. How much cash on hand is really the big one. And that's, unrestricted reserves divided by your annual operating costs. And our debt to operating ratio, which is our total overall debt dividing by operating revenue. Those are the 3 main metrics used by Moody's. This again shows it, in less words and more kind of a grid format, coming from Moody's back in 2022. Adding up to the financial piece of it adds up to a little less than half of the overall credit rating. These are the kind of metrics to stay in line with a AA, which is kind of where we're at now and what we're striving to hold on to. And so, and Larry asked this question at the beginning: our debt service coverage right now on a budget basis, assuming everything comes in as planned, this year we're budgeting for about a 2.5 debt service coverage. So we're really nicely in that range of, well better than AA. And then in the future years, because most of our expenditures are going towards capital, it actually increases our debt service coverage. We have more operating surplus because capital is kind of taken out of that equation for that particular metric. Cash on hand, where we're at now with that is much closer to the lower end of the AA. So right around 150 days. Again, that'll depend on final calculations in terms of our year-end accounting. But we're really on the low end of AA now. So still in the AA territory, but much closer to that 150-day mark than we'd probably like to be. So I think if we get ourselves up towards that kind of what we were talking about in terms of the $70 million number, that gets us a lot closer to the 250-day mark. And so I think, again, that's another outside indicator that that $70 million mark is probably closer to where we'd be expected as a AA agency. And then finally, debt to operating revenues at the bottom there. We actually have a pretty low level of debt right now. We have a lot of debt capacity. And so our debt to operating revenues is well above 2 or well below 2 right now. So we're in a nice range there in terms of overall debt. And that's just a way of saying, are you over leveraged, right? Do you have more on, in debt than you do in an annual budget? And so we don't. We have a pretty low level of debt right now compared to our overall budget. And so we're about 1.2 right now. So we're under 2 there. So basically 2 of the 3 metrics we're in good shape in, and the days of cash on hand, hence the reserve discussion, we're kind of bordering on that lower end of AA. But I think we have a plan in place and a good, rate structure underneath us and a good rate process where credit agencies will still, I think, be in line to give us the AA rating going forward. I don't see a risk here. I just wanted to mention that these are the factors they look at.
Brett, sorry.
Sure.
I realize I understand our debt to operating revenue ratio. We're well below 2, you said, but I don't understand our annual debt service coverage ratio. Can you?
So debt service coverage, and so you basically take your operating revenues, not counting your debt service payments. And so once you've paid all your operations and maintenance, revenues minus expenses, what's your surplus, right? And then you say how much is, so to make it easy numbers, right? $10 million is our debt service now. We need to have more than $12 million of a surplus to have a 1.2, coverage, right? So we do have that now on a budget basis because so much of our rate revenues are going to capital. We have a little over 2, I think it was 2.5, I said. So if we have a $10 million debt service, we have about a $25 million surplus right now because we're shooting so much money over to our capital program, right? Because the way they look at that is if you had to pull all your capital back and pay all your debts, you have to pay your operations and maintenance. Do you have enough money to pay your debt service and then some? And so the answer is yes, we do. And it's a metric just to make sure on an annual basis for cash flow purposes, you have enough money left over to pay your debt service each year. And as you can see, the agencies want well more than 1, right? You're in B status if you're anywhere near the 1 mark. A status 1.25. Our policy is 1.5, which is right in the middle of that AA kind of marker, right? Actually, right in the middle of A. And so but our practice has been to be well above 2. And so that's what helps us out to have enough of a surplus from our rates to be able to pay our debt service in any given year. It also helps us that our capital maintenance fee can be used to pay for debt service. So you can pull that into the equation. So we'd like to use capital maintenance all the way for capital, but you are able to pull that over to pay for debt service. So that really helps that metric as well.
So just to confirm, it is surplus after operating expenses are accounted for,
Mhm.
even though we may be using that surplus for other expenditures like capital expenditures now.
Exactly, like capital or like building reserves, right? So it's one of those things where those are very discretionary for the board, but they just want to know that after you've paid your annual operating and maintenance to keep things going, do you have enough discretionary funds left over to pay debt service plus? And so we show them, yes, we have the surplus. And then once we have that, we're not bound to hold it. So we spend it in capital, or we spend it on rebuilding reserves, or we spend it elsewhere to invest for the agency. $1.25 is the bond covenant. Yeah. So it's
profit and spend on the, like, it's kind of, it keeps my life kind of not in tune. Okay. But it works. And it's, these guys know what they're doing. Movies and things. You know what they're doing. They're watching the background. They're watching. I remember a comment they made. What significant impact on our credit rating was willingness of the district to.
That's right. Yeah, to establish the fixed CMF and willingness to raise rates in the 2019 cycle was definitely cited as a reason for the upgrade.
And Larry, you think that their analysts, they're well familiar with the limitations of the 218 requirements. It's just an interest. I don't think we need to debate that, but it's just curious to me. I would guess that they may not be that familiar with.
No, these guys they're familiar with the district. They're watching. Because the big bond guys they're worried about people going down. So they're very cautious. And they put themselves between the purchase of the bond and the bond taker. I don't know what it's called. But so they're always watching. And how often do they look over our shoulder?
I believe they do a cursory review once a year. Is that right? Yeah, each year we have to
What do they do
turn our
once a year?
financials, and then anytime there's a significant change in what we're doing or in the overall market, they want a deeper check.
Yeah.
And so whenever we go out for bond funding, if there's a big shock to the system, they would want a deeper check on us. And then each year they're kind of updating their high end metrics to make sure we're not falling below the where they would expect us to be.
That's
There-
great. This is, I just want to be mindful of our time here in a little bit, but this is really helpful. Is there anything else that we?
Oh, they're much happier with utilities than they are with people like sewage agencies. Because utilities make money. So it's a much easier model. It's like a business, a real business. You get to sewage where it's paid as a fee, then they just have to manage what they have. They're kind of like school districts. They're kind of stuck. Whereas we generate income, like PG&E, they generate income. And we've seen the problems with PG&E. You know, you can get yourself in real deep, real quick, not really realizing it. I'm real curious about, not for today, but how you arrived at those legal fees for a wildfire. You know, that's a very interesting question. What responsibility would we have in a wildfire?
I wasn't intending to make it wildfire specific. I was just saying natural disasters and other
got it.
risk.
Yeah,
But,
and it's just a number. I got that too.
Oh,
But
yeah.
it's the number it's kind of interesting.
Yeah. I have a background for it. I'll bring it to you next time. I think it was based on the matching FEMA grants and what might be deductibles on large losses, but I can bring that back to you.
Okay.
I was confident you had backup for it.
Okay. So let you finish up.
Yeah, just so in summary, again, we're talking about this now because we had changes to our budget and rate structure, and which changed our overall risk, kind of portfolio. Reserve policy, as I just mentioned, with credit ratings and other areas, has the greatest impact on our fiscal health. We did use our reserves, and so we need to be able to replenish those. And that's kind of the key here is how fast and how to replenish those to be better prepared next time. We also need to update some language elements within our fiscal policies, and those are attached to the staff report. I would recommend at this point, making sure we're okay with the minimum targets and clarify some of the calculations that are in that, because I think they've been written over different years for different purposes. So maybe taking a fresh look at the language behind it. And we'll come back in September with more specific recommendations for the board to consider. And then we'll start to talk more about debt management as it kind of interplays with this as well in September.
Fantastic. Okay. Any other final board comments? Okay. Any public comments?
There are none.
Okay. Fantastic. With that, we are adjourned. Thank you so much.